That leads us to our talk of the tape. As investors struggle to sort out the likely economic toll of the banking crisis, are Yellen and Powell sending mixed messages to the market? With us now, Joe Terranova, CNBC contributor and senior managing director of Virtus Investment Partners, and Alicia Levine, BNY Mellon Wealth Management, head of investment strategy and equity advisory solutions. Welcome to you both. We have to bridge the D.C. to Wall Street divide here a little bit, I think, and really just talk about the whole collective of what Powell did yesterday, what Powell said yesterday, what the Treasury and Congress are dealing with regard to banking stability, and then the market's attempt to handicap just exactly what kind of a drag that's going to have on the economy and earnings, Joe. What do you read into today's action with regard to all that?
Well, the market seems to be following the direction of the Russell, obviously, because of financials. We had a nice bounce this morning. Mike, I still think what I'm most bearish on is time, not so much price. I don't think people fully understand this is a correction, the magnitude of which we have not seen since the great financial crisis, and we're continuing to consolidate in this range between 3,800 and 4,200. We've only had two closes since the midterm election below 3,800. So I think as it relates to Treasury Secretary Yellen, I think the market expects or wants her to do something that in reality she can't do. First of all, she legally can't do it. Sure. Because of the requirement that Congress would have to raise the limit on FDIC. But I think that Treasury Secretary Yellen is trying to communicate that she doesn't think she needs to do it.
That's right. Yeah.
Now, the market is saying something completely different. And I think what you look at is the market always ultimately. I think the market has been right throughout this process. But lastly, let's remember something. Treasury yields, in particular, a two-year Treasury, Mike, it's down 140 basis points since 10 days ago.
New low for the year.
That's right now, actually helping and offering some relief for a lot of the long-term assets that are sitting on bank balance sheets that were so stressed 10 days ago.
That is true, although, Alicia, what it also means is the market has quickly gone to pricing in a pretty significant round of Fed rate cuts later in the year. Fed says that's not going to happen. The market thinks it's going to happen. It's going to press that bet. And it really gets to the point, which is we're now closer to when the Fed perhaps is done tightening than we thought we were going to be a couple of months ago. But at what cost in terms of what it means for the economy?
Right. And the question is, of course, why will the Fed be closer to the end than to the beginning? And is the Fed done altogether? And of course, the answer is, well, that must mean that there's a slowdown coming in the real economy driven by the contraction of credit from the small and medium-sized banks, which they will have to do in order to right-size their business models as of today. And the stock market's actually really interesting because it is hanging in there to that 3,800 low, really looking through what might happen in the real economy to where the Fed's going to cut. And it's taking the lead from the bond market to say, look, if the Fed is done and if there are cuts by the end of the year, we're going to stabilize and therefore the market's going to be okay. Now, the question is this the trade after the trade, or do we have to live through something worse in between?
Right.
Right now, the stock market's telling you it's going to be all right.
Or that there's a path, right, to it being all right. I mean, look, the formula seems to be Microsoft goes up almost 2% a day, and that means that the regional bank stocks can be down 3% every day. I mean, that can only go on for so long. It seems that relationship's gotten a little stretched.
It's very stretched. It's very extreme. These kind of parabolic moves don't last for long. There's an end to them, and when they end, those relationships tend to right-size themselves. But again, when we still have Treasury Secretary testifying on this, it's in the news, it's in front of mind, and there's rush to those stocks that are the safety trade, which have historically worked. And the question is that really where we're going here?
Yeah, Joe.
I think the market sees the disinflationary effect. And if there was anything that I was disappointed in yesterday, it was Chairman Powell did not really acknowledge properly the disinflationary effect. And the disinflationary effect means ultimately that when he used the word pain, he was probably correct in using that word, because that really is what is ahead for consumers. You look at commodity prices, the significant decline that you're seeing there, that's signaling the disinflationary effect. You're seeing the flight to gold. Mike, you're using Microsoft as an example, but a lot of these mega caps are perceived to be as not in need of capital in an environment where we know 3 to 6 months from now, if you get your hands on capital right now, don't worry about what the rate is. Get your hands on the capital and make sure that you have the liquidity.